Good evening, everyone. Welcome to IQI Canada Evening Talks. My name is Yousaf IQI, country head of IQI Canada. And yes, it's that time of the month again, and we have none other than our chief economist, Shan Saeed from IQI. Good morning, Shan. How are you doing? And good evening from Toronto.
Good morning from Kuala Lumpur. Thank you for having me again, Yusuf.
No, thank you. Sean, it's always a pleasure having you on that. I was, every Tuesday we have a training with our team, what we call as a Terrific Tuesday over here. And this time on Terrific Tuesday, I was actually going through my team and telling them, that how important it is to have somebody, an insight from someone like Shan Saeed of what's going on around the world, what's happening in the market. Because at this point in time, there's so many things going on in the market. Well, it always happens, but then all over the world it's happening right now, whether it is related to interest rate, whether it's related to recession, whether it's related to so many things on that. So thank you so much, Sean, for all your insights. Really appreciate it. And, and to our audience and viewers, if you really want to know what's going on around the world and in Canada, do follow Shan Saeed on his LinkedIn account and also on Facebook account. So,
Thank you,
Sean,
Yusuf.
thank you so much. Let's get straight to our questions. And before that, I just want to talk about the Wall Street General weekend issue. What it's talking about. Uh, you know, a massive sell-off in bonds, a plunge in tech stocks. The implosion of cryptocurrencies, the highest inflation in 4 decades. Jeremy Grantham, best known for predicting the market crashes of 2008, gave many reasons to be pessimistic even after the initial bursting of what he called a super bubble. Investors should wait until the markets have hit their bottom to buy, says Mr. Arnott, and that hasn't happened yet, in his opinion. Buy too early and your investments will fall further. Buy too late and you will have missed the best opportunity to make a profit. US stocks still look expensive to Mr. Arnott, the son of pastor who turned a love of computers, math, and research into investment, advisory, business research, affiliates. He is known within his industry as the godfather of smart beta, a, a reference to funds that allocate money based on factors like companies, dividend, payment, sales, and volatility. The problem is identifying the moment of peak fear. When investors have gotten so pessimistic, there is nowhere where there's now like for prices to go but up. So Sean, last week we saw a meltdown in the tech stocks with the big names took massive hit in on the valuation tenth amount of nearly 1 trillion. What can we call bazooka or bloodbath or Armageddon?
Thank you, Yusuf. You have picked up very important question. What happened last week was not bazooka, it was not bloodbath, but I think it was a total meltdown. And this is not the first time. If you recall, 20th November 2018, FANG stocks lost nearly $957 billion. $957 billion in 4 years ago was roughly the GDP size of Indonesia. And now, after 4 years, we have witnessed the same. So I think the market will continue to stay volatile. There will be a lot of chaos in the market. So bloodbath and bazooka, they are small words now. Now we are heading towards Armageddon and meltdown, the way the markets are moving. And as you know, day after tomorrow, Fed will have the meeting, and the market is expecting, and we are expecting that Fed would hike 75 basis points next month. And there's another meeting in December, and Fed is expected to raise by 50 basis or maybe 75 basis point. So right now the discount rate is at 3% in US. It is expected that by year end they might touch 4.25 or 4.5, and by next year before March we expect the discount rate to touch 5%. That is massive because inflation is getting out of hand, And the central banks, the only tool that they have right now is to raise interest rate. So what we are following right now is the Paul Volcker's playbook. In 1981 and 1982, he followed the same strategy. Jerome Powell is following the same strategy what Paul Volcker did in 1981-82. So I think the markets will take a massive hit, and already investors have lost $63 trillion a year to date in the equity and bond markets. But if you recall history, in 1931, S&P 500 went down by 34%. In 1937, it went down by 31%. In 1974, during the hike of stagflation and recession, it lost 25%. In 2002, when we had dot-com bubble, uh, S&P 500 went down by 26%. And in 2008, when I was in Chicago, it lost again 31%. And this year alone, S&P 500 has lost 25%. And if you go back to 1929, I still remember October 18th and 19th, just in 2 days, it the market went down by 12 to 11%. And Dow Jones Industrial Average went down by 82%. 82%. That was huge. So I think markets will continue to stay volatile. That's why investors are feeling nervous. We have seen sovereign wealth funds, family offices moving away from equities and bonds, and they're going into real estate. And real estate market has been, in some places it has been down, but majority of the places like in Malaysia or in Vietnam or in Philippines, Cambodia, or in Canada, the market is still quite favorable for those sophisticated and smart investors. So I think we can expect further volatility, we can expect further chaos in the equity and bond markets, but there are still crowd, there are opportunities everywhere who still think the market will go up. But as you rightly pointed out, I follow Germany because Germany is quite famous in US, and the gentleman brings huge credibility, and Arnold as well, who is the founder of Smart Beta, that US equity markets are still overvalued, and we expect with recession coming next year, the market will take further correction by at least 10 to 15%. The equity markets are not based on reality, they are based on printing presses unleashed by the global central banks in the last 15 years. And now with Fed and all those banks tightening, we will have liquidity crisis next year. 95 central banks have raised interest rates this year. So the markets will stay volatile for the next 5 to 6 months.
Thank you, Sean. Thank you so much. Once again, people are watching us. Welcome to IQI Canada Evening Talk. We are live with Shan Saeed, our chief economist. Shan, that brings me to another question. We're just talking about the bond market. Now, bond market is facing liquidity issue. We have witnessed in the gilt market in UK after September 23rd, mini budget announcement with yields spike. Do you think that more global sovereign bonds will remain under pressure with investors' sentiments staying bearish?
Yes, Yusuf, this is a very important question. What happened on 23rd September when the ex-chancellor of UK, he came up with a money budget? That mini budget was very unfunded. There was no plan, and the markets really punished the finance minister for his, I think, irrelevant mini budget. The market of pound sterling went down from 1.12, it went down to 1.05 just in 3 days. 26 September, it went as low as 1.03, but then it stabilized at 1.05. So market went down by 6.66% just in a matter of 3 days. And if you recall Brexit, on 23rd June 2016, pound sterling was trading at 1.51. And on 24th June, less than 24 hours, the pound sterling went down by 10%. It was trading at 1.35. So wherever you have economic policy that has got a huge risk, the markets are going to punish you, because if the markets feel that you don't have a sound economic policy and your economic policy is carrying the growth risk, they're going to punish you. So I think the bond market will continue to stay volatile. If you recall, Andrew, the Governor Bank of England, told the pension funds to get out of the market in 3 days. The gilt market, if Bank of England had not intervened, would have collapsed. So just imagine $1 trillion of gilt market, the bond market in US would have collapsed with a hike in, spike in yields. And then the central bank had to intervene and they had to step in to tell the pension funds to get out of the market. So that was a clear signal to all those players that central banks are in charge, and you cannot, go against the central bank. They are the final authority. So it was a good move from part of Andrew, Governor of Bank of England, that he took that position. Otherwise, it would have created havoc for the bond market. Moreover, I can share with you Harvard Endowment, one of the biggest endowments in US, because I was involved with University of Chicago endowment. I used to raise funds. Harvard Endowment has took a hit of $3.2 billion. $3.2 billion. And I
Wow.
have been saying all
Wow.
along that pension funds, endowment funds, institutional investors will take a hit because of this havoc and bazooka in the equity and bond markets. So the first injury has been uh, gone to the Harvard Endowment, unfortunately, although Harvard Endowment has always made money. But this year they took the hit. I think Harvard Endowment is not the last one. Many pension funds, many endowment funds, many institutional investors will take the hit of this volatility in the bond market and equity markets. Excuse me.
Thank you, Sean. Thank you so much for answering that question. Once again, we're live with Shan Saeed, our chief economist for July IQI Canada. If you have any questions, any comments, anything you want us to answer, any concerns you have, anything you think, where you would like to have some information, please do drop us a comment, a line. Do contact Team IQI Canada, and we'll be more than happy to connect you with Sean. At least, address those questions in our next sessions as well on that. So Sean, what I like to do is that I like to bring in this chart and talk about this chart from
Yes,
PIMCO, which is from
yes.
March 2021 and has been rather correct with the benefit of insight. In which quadrant are we moving now? Towards the top left, which is the stagflationary growth.
Yes, Yusuf. Fortunately, those investors who are following us, and in our newsletter in November 2020, we have specifically mentioned that stagflation is going to hit advanced economies. And PIMCO chart validates our call that what we made in November 2020, we were ahead of the mainstream media. We were ahead of many global banks, asset companies, endowments, pension funds, bond managers, fund managers. So at that time, not many people believed us. And they said, Shan is just, creating an outlier. But now everybody is talking about stagflation. People are aware of what is stagflation. Just 11 days ago, I was invited by SIDC, that is the training arm of Securities Commission in Malaysia. That is a regulatory body of the stock exchange. And over there, I was talking about stagflation. I was talking about in April this year, we were talking about recession. And now, just before taking your interview, I was on Astro Avani. I was saying that QE is coming into the market. So if we have seen history since 1960, 85 hikes have taken, and two things have come out very significantly. One is the central banks have stopped hiking rates after the inflation has decelerated from, let's say, from 5 to 4.5%, 10% decrease. And second thing, uh, central banks have cut interest rate right after 7 months from the last hike. So these things are happening right now, and this will eventually happen. QE is coming, so everybody is waiting for the groom. When the groom is coming, so QE5 has become the groom. So now the markets are coming, are waiting when the groom will come, and we will have liquidity again. Because right now the central banks are tightening liquidity. So there will be a liquidity crisis, and then the Fed will change its pivot, and they will say, no, 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 it's not about inflation. Inflation is coming down. Now the pivot is moving towards economy. So economy can't take the pressure of higher interest rates. So the narrative that the central banks will come up that inflation is coming down, although maybe a half percent point or 1 percentage point, but inflation will stay. But they will say inflation is not the main focus. Now the focus is economy. So they will change the narrative and they will go to QE5. So as I said, everybody is waiting for the groom. QE has become the groom. So once the groom will arrive next year, I think the markets will be very happy and we will see a rise on equity and bond markets.
Thank you, Shan. Thank you so much for that, for your valuable insights on that. Uh, that brings me to my another question, Shan. Last week, BlackRock shared its commentary and analyzed the sector to benefit from post-COVID era. Would you like to shed some light on that? And I'd like to share a slide as well on that.
Yes, Yusuf, as you know, in the last 6, 7 months, not last 6 months, 1.5 year, we have been following BlackRock's insight, and they have been quite relevant. As you know, I don't follow the mainstream media. We are ahead of the mainstream media in terms of a call by 1 quarter, by 1 month, by 5 or 6 quarters. BlackRock has come up with something very relevant, very basic, and very fundamental. What do you need in your daily life? You need oil and gas.
Yeah.
What do you need in your daily life? You need electricity, utilities. What do you need in your daily life? You need detergent, you need toothpaste, you need food. So what BlackRock has shared in this insight, they have mentioned about the basic thing, oil and gas. They're talking about energy. You don't want to go shopping because there is a traffic jam. You go online and you order everything. So they are talking about e-commerce. If I take away your mobile for the next for 24 hours, can you operate? No. Your
No.
bank, your contacts, your connection globally, it's all on your smartphone. So smartphone has not become a luxury. It has become a necessity. So you can't stay away from a necessity. Water. If I don't give you water for the next 48 hours, can you survive? No. 70% of your body is water. So I think BlackRock insights are very valuable. And as I say, these are contrarian insights. And I'm a contrarian economist. I don't follow the mainstream media. I look at the other side of the coin. So there are three sides to every story: your side, their side, and the truth. And at IQI, we try to find the truth. What is going on in the market? What is a contrarian view? So people say looking at one side of the coin is like a microeconomics. I don't follow microeconomics. I follow the macroeconomics. And if you see people who understand monetary landscape, they really understand what is happening in the global macroeconomy. And if you do, I mean, you also understand that the markets right now are expecting a systematic and liquidity risk coming in the next 6 to 9 months because of uh, Fed tightening and central banks tightening. So once you have that, that will create panic, and once the investors will have panic situation, they will go back to these basic and fundamentals thing. And they have also mentioned about some of the basics like real estate as well. So if you understand the markets, the macroeconomics, I mean, it give you a lot of insight. And I have been sharing with press and media in Malaysia. I follow the debt market, the bond market, the fixed income market. If you follow that bond market or the debt market, you understand what is coming into the monetary landscape, the fiscal landscape, how the equity markets will behave, how the commodities will behave, the real estate markets, the currency markets, the fiscal landscape. So it gives you a bigger picture. So if you understand one asset class, that is debt market, you understand all the asset class, whether it's equity markets or real estate market or the commodities market or the currency market. So I think what BlackRock has shared, we also share in our newsletter most of the time. We share insights from JP Morgan, Bank of America, UBS, and BlackRock. So I think these four institutions have been quite relevant, and they have shared a lot of insights that are quite relevant to the market, and markets are following their insights quite closely.
So, Shan, very interesting. You just were mentioning a few things. What is the necessity? What's not necessity? So, I just want to share a very small thing which happened like last week when I was in Chicago, talking about the cell phone, that how important the cell phone is. So, while after having dinner, I went to this place to get a cup of tea, and then all of a sudden I don't realize I keep my phone outside. I come out, next door shop goes in, and immediately I realize after 5 minutes that my phone is gone. And then this shop got closed exactly at 9 p.m. And I started freaking out because all my contacts, everything was in my smartphone. And I said, okay, what do I do now? Where do I do it? So I started looking around at a couple of places where it's supposed to be. And then I went back to next door. I said, you know what, can you please try to call this guy out? He said, they're gone, but let me try to find out. But he said, hey, but are you sure you dropped it over here? I said, let's try it. So we tried calling it, and we could see the phone ringing in there on that. I mean, that 1.5 hours of me thinking that if I don't get my phone now and have to wait till 24 hours, it's going to be a panic situation. So you're right. Now things have become unnecessary. But I got my phone after an hour and a half, and then you start realizing, oh, how important it is that we're so much data we've got and so much reliability we've got on this right now.
Absolutely. So I have been sharing that your smartphone has become your way of life. It's not a
That's right.
luxury anymore. It's
Yeah.
it's part of your life. So if your part of life is taken away, you start panicking and you don't know what to do. Like Chicago is like my third home. When you talk about Chicago, it's very emotional for me because, and you have also shared picture of University of Chicago standing outside
Yeah.
Bleacher Center.
Yeah.
So I think yes, I would say smartphone is very important, and you can do a lot of good things with your smartphone instead of watching movies on smartphone.
Absolutely. So we're live with Shan Saeed, our chief economist from GY IQI, all the way from Malaysia. I always say that please follow Shan Saeed on LinkedIn, follow him on Facebook. If you really want to know what's happening around the world, just not in Malaysia, but everywhere around the world. And I think it's very important for our smart and sophisticated investors to follow this because we are an advisors. And the way we work is that we just don't go and sell stuff, but we, being as advisors, look at a lot of things, and those valuable insights are coming to us by one of our chief economists, Shan Saeed, on that. And thank you so much for that, Shan. Shan, my question to you, which is a very very hot topic right now, which just happened on 26th of October, was that the interest rate, which took another hike of another 50 basis points. So discount rate at 3.75%, 3.75%. Can we expect a break next year as central banks have done enough of the inflation? And can we expect that real estate market to weather the hikes in the rates and stronger sentiments to continue? What's your take on that?
Yes, Yusuf, as I shared with you, and you rightly pointed out, that central banks will keep on hiking rates for the next 2 to 3 months, and then they will take a pause, and then the narrative will change that inflation is coming down. So inflation is not a concern. Now we have to bolster the economy. So narrative will change from inflation to economy. So once that comes into the landscape, once that comes into the equation, then we can expect interest rates to come down, and we expect interest rates QE5 come into the market by September 2023, because markets can't take the pressure of higher interest rate, and that is known to everyone. And from 1960, what we have observed from historical data, 85 hikes have happened. And after the 85 hikes, we have come to this conclusion, and there are two significant points, that central banks have got a pause, and they said inflation has gone down by a meager 10%, let's say from 5 to 4.5%. And the second thing that the central bank would say, that we have hiked interest rate enough. Now we have to support the economy. So after the last hike, after 7 months after the last hike, they will cut interest rate. So once you will see the interest rates being, coming back to the normalization of monetary landscape, as we call it, what does the market expect? The market expects the central banks to cut interest rate by next year, and that will create opportunity. And once the interest rates will come down, we will see more investors moving into the equity markets, bond markets, and of course real estate. So I think equity markets will weather the storm. I was talking to you 2 days ago, you said
Yeah.
the market in Canada, still there is a lot of attraction. Investors are coming in, and you just sold a big land for 13 million dollars. That was huge. And I think what you are doing right now is very important. What we have been sharing, when the markets are bad, you only have one strategy, and that one strategy is engagement with those investors. What is coming into the market? What can we expect? So you give them the present and the future. So once investors, they stay engaged with you, they trust you. And in these tempestuous times, the only fixed asset that goes up is land. And investors, they value you most if you updating them with right information, followed by facts and figures based on critical reasoning and based on substance. So my advice to you is, stay engaged, stay share facts and figures with them, share things from BlackRock, JP Morgan, Bank of America, UBS, Economist magazine. I read Wall Street Journal and Financial Times every day, and I'm sure on Saturday and Sunday you do the same, reading Economist magazine and Wall Street and Financial Times. And what we are trying to do at IQI to share data backed by facts and figures, so that are those investors who are following us, they don't say, oh, Shan or Yousaf, they are not sharing relevant information. So everything has to come with facts and figures, based on data. What is central banks are doing, what sovereign wealth funds are doing, what pension funds are doing, what endowments are doing. So those retail investors, they need to follow all these big players like BlackRock, Blackstone, sovereign wealth funds like, Khazana in Malaysia, or Qatar Investment Authority, or GIC in Singapore. So I think if you investors, they follow our insights, they can benefit a lot. Excuse me.
Great, thank you so much, Sean. I mean, I think that's that because we've been getting asked this question quite a number of times. Like, what's the outlook of interest rate is going to be? Because yes, the average prices of the Canadian real estate market has gone up, right? For so many years, we've been looking around it around, and an average, and I say average price has gone over $1 million of a house. So the concern does comes in when you see this interest rate hikes because with the prime rate going from 5.45 to 5.95, a lot of people are still thinking that, the trigger, the trigger does not hit for the interest rate and things like that, but let's really thank you for that. It's a good thing for our investors to learn as well. That we should expect the interest rates hopefully to start getting a bit down on it. I think Rezi rightly said the investors who are really smart right now and sophisticated and who have the liquidity of really holding on to the funds. These are the people who know that Canadian real estate market over the years have been growing and will continue to grow as well. Immigration, as we always talk about, is one of the major factors of people coming in. International students coming in, getting their work permit and getting into their PR card on that. Tourists will start coming in as well. So lot of backlog which has not happened is going to be there. So I think the spending is always going to be there, and real estate being an asset, something which you can always, has been very hot, and for generations of people to start, investing and keeping it either for themselves, for the generation is going to continue for that. Thank you very much, Sean. Anything you would like to add?
Yes, the most important thing that I'm going to say right now, people who understand history and economics, they have always taken position in tangible assets. Those sophisticated and smart investors, if you look back at 1970s, 1980s, two asset classes came out significantly: real estate, gold, and silver. So I think what we are witnessing right now is the same. History is repeating. So the ructions, as I said, the ructions in the markets, are of a magnitude not seen for a generation. And the alchemy of financial markets has changed dramatically in the last 15 years. So, real estate, gold, silver, farmland, arts, these tangible assets where you can touch will remain on the global investors' radar. I still remember you told me in 2020 that Shan HSBC rates for real
Yeah,
estate is 0.99. It's
that's
not
right.
long. Just two
Yeah,
years ago, HSBC was offering interest rates of 0.99 to those real estate investors. And
that's right.
last year, I still remember Financial Times and Economist magazine said that average home price in Canada has touched $1 million. So everybody is a
That's
millionaire.
right.
Everybody
Yep.
is a millionaire. And
That's
in
true.
June this year, in Economist magazine, they said if someone has invested $100 in Canadian real estate by 2021, it has gone to $325.
Very
That
true.
shows the potential of the market. That shows the real estate appreciation in a market that is mature, that is only for sophisticated and smart investors, and most importantly, the market that provides stability.
Yeah.
So I always say that we have shared in our newsletter, invest in property, invest in stability. So this is a new tagline from IQI: invest in property, invest in stability. And when do you want peace of mind? Those sophisticated and smart investors, what they did in 1970s, they're doing the same after 52 years, that they are going into these asset classes: real estate, gold, silver, arts, farmland, agriculture. So I think I would say history, those sophisticated and smart investors who understand history and economics, they have always taken position in tangible asset. Real estate is the new global currency. I have shared in 2015. It is now becoming the talk of all the markets. So I think real estate will continue to be on the global investors' radar.
Great. Thank you. Thank you so much, Sean. Always a pleasure having you on the IQI Canada Evening Talks. There's a lot of questions which do come to our investors, but I know we have short of time and you got to run as well on that. So thank you so much for that, Sean. Have a wonderful day. To all of our audience, please follow Shan Saeed again on LinkedIn, follow him on Facebook. If you have any questions, anything you would like to talk to, you want us to talk about us, do let us know. With this note, take care of yourself, and we'll see you again. Thank you. Bye bye.
Thank you. Bye bye.